Super Microcomputer Incorporated stock is up by 717% in 1 year. And Howard Marks, who is one of the greatest investors ever, sold it almost exactly a year ago.
Well, nobody's perfect.
So let's try to understand what caused such an incredible growth. Is such a valuation justified, and can we still make money on this investment? Super Microcomputer Incorporated develops and manufactures server and storage solutions. Its main advantage is the ability to offer highly customizable and energy-efficient products. And its recent results can give us a first glimpse at why the price went sky high. Revenue is up by 103% year over year. Net income is up by 68%. Cash is up by 64.7% in half a year. And debt went down by 17.3% in the same time. So short-term results are absolutely beautiful. But if we concentrate on the short term, we are rather speculating and not investing. So let's take a look at the big picture. If you were to invest $1,000 into this company 10 years ago, you could buy around 46 shares. And now they would be worth close to $34,053. And that is a gain of 3,305% in 10 years. Well, not bad. It's actually
pretty good. Pretty good.
Individual insiders, that is a check. 14.9% of the company is owned by individual insiders, and we would like to see this number over 2%. So that is some great news. The management has its skin in the game, and so it will take good care of the company and of the shareholders. And are individual insiders buying? That is an X. They are selling a lot of shares in the recent year, especially in the last 3 months, when the price gained another 190%. And do super investors own this company? That is an X. Howard Marks and Lee Ainsley used to own this company. But Ainsley sold his shares at the end of 2021, and Howard Marks did the same a year later. So Ainsley was too early for sure, and Marks probably made a nice profit, but nothing close to what it would be if he just waited another year. Well, it just shows that it is never easy. Return on invested capital, that is an X at 9.6% 10-year median returns. And we want to see this number higher than 10%, so it is just a little bit lower than our expectations. Not bad, but not great either. And what do we know about net profit margin? It is a check at 7.8%, and the industry average is around 4.7%, so a decent margin. And now let's take a look at share buyback. It is an X. In the last 10 years, they issued 19% extra shares, so they are diluting long-term investors. But maybe it's not such a bad idea. If a company believes that its stock is very expensive and it needs money for growth, then issuing new shares can be a cheaper way of getting cash than, for example, getting into debt. So, what is the situation with debt? It is a check. It would take just over 1 year to pay the long-term debt with a 5-year average free cash flow. So, that is a nice result. Revenue growth. That is a check at 19.9% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so such growth is impressive. And free cash flow growth, that is a check at 53.6% in the last 10 years. That is great. But it does not tell the full story. Supermicrocomputer Incorporated has actually a very volatile history of its free cash flow. So this growth may look great now, but in 1 year's time, it can be negative again. And earnings per share growth? That is a check at 37.3% in the last 10 years. And also here, we would like to see it higher than 10%. So even though they are issuing new shares, this growth is exceptional. Supermicrocomputer Incorporated is not paying any dividends at the moment. And looking at its incredible growth, it makes sense. They are concentrating on expansion, and paying dividends would just slow them down. Price to earnings ratio is 57.8. Let me repeat that. Price to earnings ratio is 57.8. And I know Nvidia has a PE of 95 right now, but the fact that other companies are expensive does not make this company cheap. Just a little bit less expensive than other expensive companies. You know what I mean. But let's value it using a discounted cash flow formula. For that, we will have to estimate its growth for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. And we will use a 5-year average free cash flow and not the recent one, because like I said before, the history of free cash flow of this company is really unstable. So taking an average should give us a more realistic picture of the company. So in the low scenario, we will estimate a growth of 18% for the first 5 years and then 15%. In the medium, 22% and then 20%. And in the high scenario, 30% and then 25% growth. So the low scenario is close to the predicted global data storage market growth of 17.8% per year. Medium is predicting that supermicrocomputer will grow much faster than the average, and the high one is a scenario in which we are much closer to the average growth of this company in the last few years. It's very hard to sustain such a momentum, but definitely not impossible. So, with such estimates, the intrinsic value in the low scenario is $60, in the medium $78, and in the high scenario $118. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any percentage that makes you feel comfortable. And with such a margin, we get in the low scenario $42, in the medium $54, and in the high one $83. And the current price is around $740. So it is all in the red, and it is a meaningful difference. So it is very expensive. But just at the beginning of 2023, the price was around $83. So basically, that is the high scenario with the margin of safety. So it was around its fair value. Now we are paying for expected growth. But with a PE ratio of almost 58, it is just absurd. To pay $58 for $1 of earnings, I don't see it. And at the beginning of 2023, it had a PE ratio of 9, so a great deal. And now it is just too late. But looking at how unstable its free cash flow is, there may be other opportunities to buy this company in the future. And it is a very good company. Financial health, growth, it's all good. But we have to be patient and just wait for the right time to invest. Is it now? I don't think so, but maybe I'm wrong. What I know for sure is that it is not the right time for me. I go to our Patreon page, look at our stock ranking, and see much better investments there. Good companies that are just way cheaper. Does it mean super microcomputer won't go up? Of course not. Markets can stay irrational for a very long time. But it does not mean that we have to participate in this behavior. As Warren Buffett once said, we do not have to swing at every opportunity, just the one that we believe is right for us. If you enjoyed this video, you may be interested in my analysis of TSMC, another great company in the technology sector. Thank you so much for watching and see you in the next one.